You make decent money but still feel broke. That's not a personal failure. And it's not because you're bad with numbers. It's because the tax system, the actual one, not the simplified version, works in a way that surprises almost everyone. In a minute, I'll show you exactly how much of your paycheck actually goes to different types of taxes, and why your tax bracket doesn't mean what you think it means. But the last part changes everything. Understanding this isn't about finding loopholes. It's about seeing where your money actually goes. Most people miss this part entirely. You look at your W-2 and see a number that feels reasonable. Then you look at your bank account and wonder where the rest went. The gap between those two feelings is what we're solving today. Here's the truth. Nobody really explains clearly the federal government collects about $4.9 trillion every year. 99% of that comes from taxes. But where does your chunk go? And how much is actually yours to keep? That's not a simple question. And the answer reveals something important about how the system is designed. Let me start with the most shocking number: your paycheck is already hit by taxes before you ever see it. Income tax is the one everyone talks about, but it's not even the biggest hit. Payroll taxes, Social Security and Medicare take money automatically before income tax is even calculated. For most working people, this is actually the larger slice of the pie. You're paying 6.2% for Social Security on every dollar you earn, up to a certain income cap. That cap in 2024 was $176,100. So if you make $200,000 a year, you don't pay that rate on the second half. On top of that, you're paying 2.9% for Medicare with no income cap. Your employer matches both of those contributions. But you don't see that money. It goes straight to the government. 62% Social Security plus 29% Medicare equals 91% of salary taken before income tax. That's 9.1% of your gross income. In many cases, gone before you even get to the income tax conversation. Now reset what you think about tax brackets, because this is where most people get it completely wrong. A lot of people believe if they enter a higher tax bracket, they pay that rate on all their income. That's false, and it's kept many people from earning more because they feared the tax jump. The system is actually designed as a staircase, not a cliff. Your first chunk of income is taxed at 12%. Now reset what you think about tax brackets, because this is where most people get it completely wrong. Then the next step up is 24%, and so on. You only pay the higher rate on the income that actually falls into that bracket. If you're single and make $60,000, you're not in one bracket, you're in multiple brackets simultaneously. The bottom $15,000 is taxed at 10%. Then the income above that threshold gets taxed at 22%. The jump to the next bracket doesn't mean everything gets taxed higher. This matters because people often turn down raises or side income out of genuine fear of losing money to taxes. The math doesn't actually work that way. You always benefit from earning more, even if more gets taxed at a higher rate. Here's the standard deduction, and this is where things get interesting for your actual take-home pay. For 2024, the standard deduction for a single person is $13,900. This matters because people often turn down raises or side income out of genuine fear of losing money to taxes. This means the first chunk of your income isn't taxed at all. If you make $50,000 as a single person, only about $36,000 is actually subject to federal income tax. The rest, the first $13,900, gets a free pass. This deduction has gone up every year for the past decade or so, which means your actual tax liability is often lower than people think. Most people just take the standard deduction and move on. But some people itemize instead, which means listing out specific expenses that the tax code allows you to deduct: mortgage interest, charitable donations, state and local taxes up to a certain cap. These can add up to more than the standard deduction. If they do, itemizing saves money. Most people, though, roughly 87% of filers take the standard deduction because it's simpler and often better. Now here's where it gets real. And this is the part nobody notices until it happens to them. Tax credits are different from deductions, and the difference changes how much money actually ends up in your pocket. A deduction reduces your taxable income. A credit reduces your actual tax bill. This matters enormously. If you have a tax credit of $2,000, that's $2,000 off what you owe. Not $2,000 off your income, off your actual taxes. Deduction of $2,000 times 22% bracket equals $440 savings, versus tax credit of $2,000 equals $2,000 savings. The credit is worth nearly 5 times more in this scenario. The child tax credit gives you $2,000 per child under age 17. The Earned Income Tax Credit, the EITC, can give families making under $55,000 significant credits that sometimes result in refunds. These refundable credits mean you can get money back from the government even if you owe zero tax. Some people with lower to moderate incomes end up with refunds of $5,000 to $13,000 because of these credits alone. Most people working at regular jobs never realize they qualified for these. They file their taxes, get a small refund, and move on. But the system is designed so that if you qualify, you get that money. That's not a loophole. That's how it's supposed to work. Here's the part that explains why high-income earners often feel like they're paying a disproportionate amount. The top 3% of income earners in America pay about half of all federal income taxes. The top 1% pays about a third of all income taxes. This isn't because they're being punished. It's because the system is progressive, meaning the rate goes up as you earn more. Someone making $200,000 might pay an effective rate of around 30 to 35% when you add everything together. Someone making $50,000 might pay an effective rate of around 8 to 12%. The gap compounds over time. If you earn $100,000, federal income taxes might take roughly $12,000 to $14,000 of that. Add payroll taxes of $9,100, and you're looking at about $21,000 in taxes before state, local, and property taxes. That leaves roughly $79,000, which explains why people making solid six-figure incomes still feel the squeeze. Now, most people miss this next piece, and it's important. Your effective tax rate is almost always lower than your marginal rate. Your marginal rate is the rate on your last dollar earned. That's your tax bracket. Your effective rate is your total taxes divided by your total income. These are not the same number, and the gap between them matters for planning and understanding what your taxes actually are. Someone in the 24% bracket doesn't pay 24% on everything. They pay an average rate that's lower when you account for the standard deduction and the staircase structure. This is the moment where a lot of people feel relief when they do the actual math. Capital gains get taxed differently, and this creates a completely separate system for investment income. If you buy a stock for $5,000 and sell it for $8,000 3 years later, that $3,000 gain is a long-term capital gain. Someone in the 24% bracket doesn't pay 24% on everything. If you held that same stock for less than a year, the gain gets taxed as ordinary income, meaning your regular tax bracket applies, which could be 22 or 24 or higher. This is one of the reasons wealthy people's tax situations look different from regular employees' situation. Wealthy people have income that doesn't come with the same payroll tax obligation. A business owner paying themselves through capital gains pays zero payroll taxes on that income. An employee earning the same amount pays 9.1% in payroll taxes automatically. The system incentivizes certain income types over others, and most people aren't even aware they're paying different rates for different income sources. This compounds over decades. Most people see federal income tax as the main tax, but payroll taxes actually hit harder for the average worker. And then state and local taxes land on top of everything. If you live in a state with income tax, that's another 5 to 13% depending on where you are. Property taxes, sales taxes, these add up fast. Someone in California or New York making $100,000 can easily pay 40 to 45% of their income in combined federal, state, and local taxes. Someone in a no-income tax state like Texas or Florida pays less overall because there's no state income tax. But property taxes compensate somewhat. The system is designed in layers, and most people feel it without understanding where each layer comes from. This is where stress enters the money conversation. Most people feel poor because the math is actually brutal once you add it all up. You earn $100,000. Someone in California or New York making $100,000 can easily pay 40 to 45% of their income in combined federal, state, and local taxes. Then taxes come out. Then rent or a mortgage. Then food, insurance, transportation, childcare, if you have kids. The percentage of your gross that's actually discretionary is smaller than you expected. It's not a personal failing. It's the system working exactly as designed. The good news is that once you see this clearly, you can actually plan around it. You can understand whether taking a higher paying job makes sense. You can see whether your tax deductions matter, or whether the standard deduction is better. The percentage of your gross that's actually discretionary is smaller than you expected. Here's one more layer that most working people never encounter but affects their total picture. Alternative minimum tax, or AMT, which applies to some higher income earners. If you have a lot of deductions, the AMT acts as a second tax calculation that can override your regular calculation and force you to pay a higher amount. This was designed to ensure wealthy people don't use deductions to pay zero taxes, but it can catch middle to upper income people in certain situations. particularly people who are self-employed or who have high state and local tax deductions. This tax exists on top of everything else, and is another reason that understanding the full system matters more than just looking at your bracket. Most self-employed people discover this when they file their first business tax return and realize their rate is higher than expected. The system has layer upon layer, and each layer is designed to be invisible until you interact with it directly. Here's what changes everything. Understanding that this tax system exists, it's complicated, but it's not random. It's designed with incentives built in. The government wants certain behaviors and discourages others through the tax code. They want you to save for retirement, so they let you deduct 401k contributions. They want you to own a home, so they let you deduct mortgage interest. They want you to have children, so they give you credits. They want you to donate to charity, so they let you deduct those donations. Once you see the system as a set of incentives rather than punishment, the whole thing becomes less stressful and more strategic. That doesn't mean you can ignore taxes or find loopholes. The IRS has teams of people making sure you don't, but it does mean you can understand the intention behind the rules and make decisions that align with them. If you're in a situation where you have choices whether to take a job with a W-2, start a business, invest, buy property, understanding how the tax system treats each of those scenarios helps you make better decisions for your actual situation. Results vary based on individual circumstances, but the pattern is consistent. The more you understand the system, the less power it has over you. The relief comes when you stop feeling like taxes are random and start seeing them as a predictable part of your financial picture. You can plan around them. You can make choices that minimize them legally. You can stop being surprised when your paycheck is smaller than you expected, because you'll have done the math first. 3 things to remember. First, payroll taxes hit harder and earlier than income taxes for most workers. Second, your marginal rate is not your effective rate. The actual percentage you pay is lower once you do the full math. Third, the system is built with incentives, and knowing those incentives means you can make better financial decisions for your own situation. If you found this explanation helpful, understanding the systems that affect your money makes everything feel more manageable. Most people never stop to do this math, which is exactly why they feel broke despite making decent money. Then you become the manager of that LLC. Now your retirement account has a checkbook. You can invest directly in alternative assets, real estate, small business loans to others, equipment, notes, or other non-traditional investments. The growth happens inside the retirement account, completely tax-free if it's a Roth, or tax-deferred if it's traditional. Let's say you have $80,000 in a self-directed IRA. You create an LLC that the account owns. You find a rental property that needs work, maybe a $150,000 purchase with $30,000 in repairs needed. You use $80,000 from your IRA LLC, plus a partner or loan for the rest. The property appreciates. Over 5 years, it's worth $250,000. That $200,000 gain lives inside your retirement account and is never taxed. Results vary based on the property, the market, and your execution, but the mechanism is powerful. Most people never access this because they don't know it's possible. Setup costs for self-directed IRA LLCs run higher than standard LLCs, usually $1,500 to $2,500, because the custodian and legal setup are more complex. But if you have significant capital and want to invest aggressively in non-traditional assets, this structure unlocks opportunities that regular retirement accounts can't. Most people miss this part. Now here's where it connects. Most people never access this because they don't know it's possible. They work together inside the trifecta. Your trust sits at the base. That's your legal foundation and your instructions for what happens to your assets if something goes wrong. Your operational LLC sits on the left. That's where your business runs and generates revenue. And on the right, you have holding LLCs for real estate, partnership LLCs for multi-owner businesses, and potentially self-directed IRA LLCs for alternative investments. This is how successful business owners think about structure. They don't just operate a business, they deliberately separate concerns: the business that generates revenue, the assets that need protection, and the growth engines that build wealth over time. Most people operate everything mixed together. One entity, one bucket, all the risk in one place. That's fine if you want a simple life. But it costs money. Here's what happens next in real life. A service business owner, say a marketing consultant making $80,000 a year, converts to an S-Corp. Their accountant runs the numbers. Suddenly they're saving around $5,000 per year in self-employment taxes. Over 10 years, that's $50,000. They don't feel it because they never saw that money as theirs in the first place. It's just money that suddenly stays in the bank account instead of going to the IRS. That same consultant might own an investment property, They create a separate holding LLC for it. 5 years later, a tenant sues over an injury. The judgment is $150,000. But because the property sits in a holding company, the liability is contained. The lawsuit can only reach the property's equity. It can touch the consultant's business, personal savings, or other investments. Most people don't think about that until the lawsuit comes. Then they understand why structure matters. A product manufacturer with a business partner incorporates a partnership LLC and puts an operating agreement in place. 3 years in, the partner wants to step back. The operating agreement specifies that the remaining partner can buy out the exiting partner at a predetermined formula. No lawsuit, no drama, just clear terms everybody agreed to years ago. Most partners have to litigate that situation because there's no document. This costs $30,000 to $100,000 in legal fees. A person with $100,000 in a solo 401k creates a self-directed IRA LLC and invests in 2 rental properties. Over 10 years, those properties appreciate from a combined $200,000 purchase price to $480,000 in value. That $280,000 in gain lives inside the retirement account, completely tax-free. If it lived in a taxable account, the capital gains tax would have been roughly $40,000. Results vary based on property performance and market timing. But the difference between tax-free growth and taxable growth is significant. Most people keep their retirement money in traditional brokerages because they don't know alternatives exist. Now here's the reset. Everything you've just heard comes down to one principle. Successful business owners don't just earn money, they organize it strategically. Setup costs vary depending on how you build these structures. You can file an LLC yourself for around $400 to $600. Now here's the reset. Self-directed IRA LLCs cost more, $1,500 to $2,500, because they involve a third-party custodian. But here's the thing most people miss. The setup cost is a one-time expense. The tax savings happen every single year. If an S-Corp election saves you $5,000 per year, and the setup cost is $2,000, you break even in the first 5 months. After that, it's pure savings. Most people never do the math because they think structure is expensive or complicated. It's not. It's just unfamiliar. Here's where it gets real. After that, it's pure saving. It's that most people don't have a clear framework for how to think about structure. They don't know what an operational LLC does, so they don't know how it fits with an S-Corp election. They don't know why a holding company matters, so they keep property in their personal name. They don't know self-directed IRAs exist, so they keep retirement money in index funds. The gap between what they know and what's possible costs them money. This is the twist. Structure isn't about being rich, it's about being intentional. A single person earning $50,000 can benefit from an operational LLC plus SCORP planning. A property investor with 1 rental can benefit from a holding LLC. A person with retirement savings can benefit from a self-directed IRA LLC. You don't need $100 million to make structure matter. You need clarity about your situation and intention about your money. Here's what actually changes when you implement this. Your mind shifts from how do I earn more to how do I organize what I earn smarter. That's a different question with a completely different answer. Most people stay stuck on the first question forever. They get raises, start side hustles, take on more clients, and still feel stuck because they never answered the second question. The wealthy answer both questions. They earn, sure, but they also organize strategically. That's the mechanism behind why the same income feels rich or poor depending on how it's structured. Now here's the payoff. The 5 LLC structures plus the trifecta framework aren't secrets. The IRS publishes everything about how they work. Tax attorneys and CPAs use these strategies constantly. The only secret is that most people never learn about them because the education system doesn't teach business structure, and most financial advisors don't specialize in it. You've just learned what takes most people years to discover. That consultant earning $80,000 might spend 5 years feeling broke before realizing an S-Corp election would have saved them $50,000 in taxes over that period. That real estate investor might hold 3 properties in personal name for years before understanding why a holding LLC matters. That person with $50,000 in a retirement account might never discover self-directed IRAs because they only look at what their brokerage offers. Now you know differently. You know that when your business hits $50,000 in profit, the math changes, and an S-Corp election makes sense. You know that when you hold assets that generate liability risk, a holding company protects what you've built. You know that when you're in business with a partner, an operating agreement is the difference between clarity and chaos. You know that retirement accounts can be investment vehicles for alternative assets, not just brokerage accounts. And you know that all of this fits together inside a framework called the trifecta. Here's what matters most. The difference between people who build wealth and people who stay stuck isn't willpower or luck, it's whether they organize their money strategically. Structure creates efficiency. Efficiency creates optionality. Optionality creates freedom. That's the progression. Most people skip it because they don't understand that structure is the foundation everything else sits on. You now understand that it is. Take one small step. If you're running a business, audit whether you're using the right entity. If you're holding assets, check whether they're protected. If you have a partner, verify that your operating agreement is written down clearly. If you have retirement savings, research whether a self-directed IRA makes sense for your goals. These aren't radical changes. They're small shifts that compound over years. One structural decision made today can easily be worth tens of thousands of dollars over a decade. That's not an estimate. If you have retirement savings, research whether a self-directed IRA makes sense for your goals. The system is designed to reward people who pay attention to structures. You're now paying attention. Everything you earn matters more now. Now's more now.